Welcome to another exciting accounting video. This video is meant to walk you through the Do It problem found on page 561, which deals with accounting for treasury stock. So let's go ahead and jump into the problem, and I'm going to walk you through not only the answer, but again the theory behind the answer. So if we look at the problem, what this problem is saying is that we have some company over here named Santa Anita Incorporated. They're a corporation, and they are going to purchase 3,000 shares of their stock, which has a $50 par value, and they're going to pay $180,000 cash on July 1st. They expect to hold the shares in the Treasury until they're resold, which is significant. They're not retiring the stock. And who are they going to buy these shares from? Well, once they're issued, they have the option to repurchase them from our shareholders, and that's who's represented over here. So, again, when we're talking about a financial transaction, we need to look at two things. One, what are we giving, and what are we then receiving? Who? Well, that's the corporation. That's who we're talking about. What did Santa Anita give to the stockholders? And then what did they receive in exchange for whatever they gave? Well, the problem right here tells us they gave cash, which is an asset. $180,000 of it. What did they receive? Look what it says right here, what they purchased, 3,000 shares. So the stockholders returned to the company the stock certificate that was originally issued when they bought their shares. So the giving is cash, the receiving is ownership. They're receiving back the ownership, and the amount is $180,000. And now we'll take a look at the dollar amount in just a second, but first I'm going to take us down to the accounting equation, which again is so very critical in any transaction. We need to find out what the impact was on the accounting equation. And again, the T account is going to be helpful here. We know the asset is increased on the left, decreased on the right. Liabilities are the opposite, as are equity accounts. So we know that the corporation gave cash. So if we gave cash, cash is an asset. Is cash going up or is cash going down? Well, if we gave it, it's going down. So we know that we're going to credit cash. And if we credit cash, we know we have to have a debit to something in order to maintain the balance of the accounting equation. We could debit assets again, or we could debit liabilities or equity. Well, we gave cash. What did we receive? Ownership. Ownership is not equity or not liability, so we're going to ignore the liabilities. Ownership is equity. Now we'll throw another loop into this problem because treasury stock does not follow the normal rules of an equity account being increased on the credit side and decreased on the debit side. Instead, treasury stock, and I'll just represent that by T, stock, is a contra equity account, meaning the signs of the account are contrary. They contradict the control account. So in other words, treasury stock is increased with a debit, decreased with a credit, and in this transaction we received treasury stock. In other words, our treasury stock increased. Now we've done the initial analysis of the transaction. What is that company going to do with that stock? Remember, it's treasury stock, so what they will do is they will take that stock and reserve it in this neat little treasure chest in the treasury. And so it's going to sit in there, and what do we do with treasury stock? Well, we can reissue it to our employees for bonuses or some kind of a stock compensation plan. It could just be a strategic move on our part to try to buoy up the market price of the stock, and that's usually what it is one of those two reasons that a company will take and purchase the stock back from the stockholders. So we haven't even answered the question though, and I've been talking at you for 5 minutes. So let's go ahead and do that. Let's journalize the transaction. Journalizing is a piece of cake once we've gone through that analysis. I'll just take you down to some proper journal form. First thing we're going to want is a date. Where's the date? Right here. They tell us that on July 1st, so I'm going to take that for my date. I'm going to go ahead and type it in here. Oh, now we got to remember all those rules that apply to the journal entries, and that is that a debit goes first. I told you right here what we're going to debit. We did that in our analysis. We're going to debit treasury stock. So I'm going to type that in, treasury stock. How much? That's kind of the question we need to answer next, because if you look at this problem, we got numbers all over the place. We got a total of $180,000 we're paying, and then we are told that there's a $50 par value and that we purchased back 3,000 shares. Question becomes, is that significant? Because if you do that math, you're going to come up with $150,000. Is that significant? The answer is no, we don't really care at this point, because all we're doing is journalizing the treasury stock coming back, and at this point we're going to ignore the par value. So I'm going to debit for $150,000. Then I got to figure out, what do I credit? Again, we've already done that analysis. I'm going to credit this asset account of what? Cash. My cash is going down. Hopefully you've noticed an error I made right here. This should be $180,000, because what's going to happen is our cash goes down 180. Debits have to equal credits, and so therefore I'm going to credit cash for $180,000. That's it.